DuPont analysis. What is DuPont analysis? It is a fundamental performance measurement framework popularized by the DuPont Corporation and is also referred to as DuPont identity. DuPont analysis is a useful technique used to decompose the different drivers of the return on equity. Decomposition of return on equity allows investors to focus their research on the distinct company performance indicators, otherwise cursory evaluation. There are three major financial metrics drive return on equity, that is operating efficiency, asset use efficiency, financial leverage. Operating efficiency. It is represented by the net profit margin or net income divided by average shareholders' equity. Asset use efficiency. It is measured by total asset turnover or the asset turnover ratio. Financial leverage. It is analyzed through observation of changes in the equity multiplier. Operating ratio. It is expressed as a percentage of the total revenue. Net margin is the revenue that remains after subtracting all operating expenses, taxes, and interest and preferred stock dividends from a company's total revenue. Efficiency ratio. This ratio is an efficiency measurement used to determine how effectively a company uses its assets to generate revenue. The formula for calculating asset turnover ratio is total revenue divided by total assets. As a general rule, the higher the resulting number, the better the company is performing. Leverage. This ratio measures financial leverage by comparing total assets to total stockholders' equity. The equity multiplier indicates whether a company finances the purchases of assets primarily through debt or equity. The higher the equity multiplier, the more leverage the company or the more debt it has in relation to its total assets. DuPont analysis calculations. There are three parameters of DuPont analysis: operating ratio, asset turnover ratio, and leverage. Operation ratio is calculated as net income upon total revenue. Asset turnover ratio is equal to revenue divided by total assets, and leverage is equal to total assets divided by shareholders' equity.
Factors affecting DuPont. Return on equity is calculated by multiplying return on asset and financial leverage. The return on assets have further two parts: the profit margin and the total asset turnover. The profit margin is calculated by net income divided by sales. In order to get net income, we have to subtract sales from all the costs like cost of goods sold, selling and general and administrative expense, depreciation and amortization, interest expense, taxes, etc. Total asset turnover is calculated by dividing sales by total asset. In order to calculate total asset, we have to add fixed asset as well as current assets. There are many current assets like cash and cash equivalent, marketable securities, account receivables, prepaid expenses, and inventory. If there is any change in these factors, this will directly affect DuPont analysis, like change in some cost of goods sold or interest is rise. This will directly affect the total cost, as the total cost will be increased, and that will result to decrease in net income. If the net income decreases, the profit margin will also decrease. This will directly affect the DuPont. Any change in these factors will lead to affecting DuPont analysis.